Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Managing Director and Investment Strategist Ryan Grabinski. Ryan, how are you doing today?
I'm doing well, Ross. It's great to be here.
Yeah, thrilled to talk to you. Obviously, a lot going on. I think we have to start with, at the beginning of last week, we saw one of the biggest down days for the market in a couple of years, a lot of volatility overseas in particular. So I wondered if you could just give me your thoughts on that sell-off, as brief as it might have been, and kind of put it in context for us as well.
Yeah, obviously, it was a relatively short-lived sell-off, and whether or not we've seen the peak in the S&P 500 for this cycle is yet to be seen. So I don't want to make any big, bold calls. I think it's important to keep in mind that, generally speaking, there are drawdowns within equities during bull markets. The S&P has been down less than 10% from its all-time high. And to kind of put that in context, it's not out of ordinary to have a year where you've had drawdowns of greater than 10% and still seen equities in a bull market. The average stock was only down about 15%. On average, that statistics actually sits about negative 13%. And then even in the best of times, the average stock is down about 5%. So if you think about it, when cyclicals are really doing well, there's always some defensive stocks that are off their highs. So generally, it's rare to kind of have the average stock not down somewhere between that 10 to 15% range, which is exactly where the recent sell-off is. I think it was a good opportunity to ultimately find some of those higher quality companies and add more exposure into that space, whether it's those companies that are generating free cash flow, the dividend paying companies, or those that have that secular long-term growth story overall.
Yeah, and I think it kind of gets back to the question of, was this just kind of a blip in a bull market, or does it portend something a little more ominous under the surface? Let's start by, looking at the earnings of the companies that we're talking about here. The fundamental picture, we're at the end of an earnings season here. How have companies done? Is the growth outlook still strong? What's the recap or the big takeaway from earnings season?
Yeah, I mean, generally speaking, the second quarter earnings season has been quite good. The S&P is expected to come in around 12% growth, a little north of 12%. So that's a really strong earnings season, and revenues are expected to grow north of 5%. So those two figures tell me that all things are well in terms of earnings and the fundamentals. I think some of the concern that is coming out now is that you're starting to see the third quarter numbers be revised in. At the beginning of July, the growth rate for 3Q was expected to be about 7.5% to 8%. That has come down to about 4.5% to 5%. And so, that obviously companies have a little bit of cover just given what's happening in the markets now. The consumer certainly is seeing some weakening, and that's coming through with some of the earnings reports on the consumer front. But at the end of the day, we're certainly getting a little later in the cycle, and it's not out of question. It's not out of ordinary for some of those consumer discretionary companies to start to see some pullbacks. The labor market has started to see some weakening. We've seen the ISM manufacturing employment components, initial jobless claims has started to trend upward. So even the unemployment rate has started to turn upward, and that's this is all consistent with later cycle mentality and the later cycle of the economy.
Yeah, and speaking of the labor market there, that has driven some of the concern about the state of the economy, whether a recession is imminent, and then also has motivated the Fed to maybe get a little more aggressive at their next few meetings with rate cuts. What are you anticipating from the Fed, and what's the interplay with the equity market there as they kind of begin their journey towards rate cuts?
Yeah, certainly. So, the market has moved rather quickly in terms of rate cuts. The market's now expecting something like 25 basis point rate cuts by the end of 2025. To me, that feels, they've gone too far the other way now. It's our expectation that the Fed has the cover to cut rates in September now and will be able to begin that gradual path in their rate cutting cycle. I think the more important thing to kind of keep in mind is that when the Fed does begin cutting rates, it ultimately, you have to be a little more cautious, a little more thought-provoking in terms of whether or not, what's the signal that they're ultimately trying to send. In all of history that we've looked at going back to the 80s, historically, when the Fed begins cutting rates, the market actually does see a drawdown of about 23% over about a 9-month period. There is obviously the one period in there that is that 1995 period where we never actually saw that drawdown, right? And equities continued to march on to make highs. There were so it's hard to say that we're in that 1995 period because we haven't seen that period never really saw the consumer slow to the extent that we're starting to see it slow today. But it doesn't necessarily mean that it has to be the end all be all. In the 3 months after the Fed cuts rates on average, it ultimately means that we're going to see an increase in volatility. And I think that's kind of what we've already started to see. Obviously, we saw the VIX spike last week. It's come in since it, and frankly, when the VIX spikes like that, it actually creates a pretty decent buying opportunity, and forward returns are actually pretty strong overall.
Yeah, I think that's a great takeaway. Is this has actually been a very historically calm market for the beginning half of this year, and if anything, we're probably entering a higher volatility regime here. Not necessarily mean that returns will be bad, but definitely higher volatility, has a higher bar to clear for investors. So we'll keep an eye on it. Ryan, I want to thank you so much for the time today, and hopefully we'll get a chance to talk to you again soon.
Thanks, Ross. It's great chatting.